all credit bubbles come to an end. They pop. And when they burst, they usually burst quite spectacularly. If you see the value of gold expressed in fiat currencies rising, so long as energy prices don't rise more quickly, that's going to be good for mines.
When you're in a bull market, the biggest moves are down. Just like in a bear market, the biggest moves are up. And that's because the market is trying to fool people into thinking that either the bull market is over or the bear market is over.
The problems are not done yet. And this is a good sign of it. When they are trading their mortgage-backed securities instead of their treasuries, they're in need for cash and cash quick, and they're in trouble.
In today's weekly recap, three financial experts, Alasdair Macleod, Peter Schiff, and Andy Schectman, break down the recent volatility in gold and silver markets. From shifting monetary dynamics to tightening physical supply, each offers a unique perspective on what's really driving prices. We've watched hours of footage to bring you the best clips of the week, so you don't have to subscribe and turn on notifications so you do not miss out our recaps. Enjoy the episode.
We've had a pullback in both gold and silver. They're now in correction territory. Corrections are very normal in a bull market. Gold is now off about 6.4% from its record high, and silver is off about 11% from its record high. But number one, I think the most significant aspect of the gold correction is that we didn't correct from 4,000. We corrected to 4,000, meaning that the correction started well above 4,000. It's not like we ran into resistance at 4,000, which is what a lot of people would expect at a big round number like that. I mean, typically, psychologically, you get resistance. We had it at $2,000 gold. We had it at $3,000 gold, though not quite as much as we had at 2,000. But a lot of people would have expected that 4,000 to be some type of resistance that, could cause a pullback, and it may take a little while for the market to muscle through 4,000. Instead, we went through it like a hot knife through butter. Yes, we had a correction, but we fell down to 4,000. 4,000 now looks like the floor for the price of silver. Now, instead of being emboldened by that, because if 4,000 is the new floor for gold, that is great news for the gold mining companies. But you wouldn't know that by looking at what happened to those stocks. The GDX is now down 14.5% from its high last week. And the GDXJ is down 15.5%. And pretty much every silver stock is in a bear market, right? Down more than 20%. Even though silver is at 48.5, which is a very high price for silver. And the fact that it was able to get through 50 all the way up almost to 55, I think should be encouraging news for silver stock buyers, because it shows that 50 isn't the ceiling anymore. We went through 50. And yes, we're back below it now, but I doubt we'll stay below it for long. Now, getting back, though, to gold and 4,000, I think 4,000 is the new 3,000. And if you recall, when we got above $3,000 gold, we did dip below it a couple of times, but we didn't stay below it very long. It really was the floor. The same thing is probably going to happen with 4,000. Now, I wouldn't be surprised if the market went back below 4,000, especially since it came so close this week at 4,016. Now, maybe that was the low. Maybe this is the end of the correction. But it's also very possible that that's not the low, that the market retests that number and maybe goes a little lower than that in order to shake out some of the speculators who may be, buying it now and putting some stops below that low, or maybe below 4,000, hoping that it won't go down there, and trying to get, kind of a low risk trade where I'm buying gold at 4,100, or maybe they got in a little lower and I'll get out if it gets below 4,000 or something like that. So there could be some people trying to do that, and, they may get stopped out. Then again, they may not. I don't know, but I don't even care, because I think that if we do go back below 4,000, it's only going to be very briefly, and mainly probably just to flush out those stops. And then the market will come back up. So I think we're headed a lot higher. I think the fact that gold went above 4,000 is a very bullish sign. But what's also very bullish to me is how the media, the financial media in particular, is covering gold's rally, and more important, its decline, because they're treating it like this is the end of some kind of speculative mania.
Massive news from India today. India unleashes silver as bank collateral with 10-to-1 gold-silver ratio, boosting global money roll. India formally recognizes silver as bank collateral with a 10-to-1 gold-silver ratio, reshaping lending, boosting demand, and igniting a new era for silver as a global monetary metal. India has taken a historic step toward the remonetization of silver, officially allowing the white metal to serve as collateral for bank and non-bank loans under new Reserve Bank of India regulations set to take effect in April 2026. The move effectively establishes a 10-to-1 silver to gold ratio in collateral lending, marking the first time a major economy has formally recognized silver's role alongside gold in modern banking. Silver joins gold in India's banking system. For decades, Indian households have relied on gold jewelry as a primary form of collateral for personal and business loans, especially in rural areas with limited access to credit. The new rules expand that privilege to silver jewelry and ornaments, enabling borrowers to pledge up to 10 kilograms of silver or 1 kilogram of gold as collateral for loans of up to 2.5 lakh, approximately 3,000 USD. The policy applies to both banks and non-banking financial companies, a sector that services millions of small borrowers, and introduces uniform valuation and documentation standards to ensure transparency. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
The largest silver refinery in India evidently has run out of stock for the first time in history. India being one of the largest buyers of physical silver, that's a big deal. I think worth certainly mentioning. The managed money is short by over $1 billion on silver, meaning the commercial banks took the other side. I wonder how that's going to play out. I would suspect you'll see silver really start to move this week when the managed money, the dumb money, in relation to the commercial banks, the ones that seem to always be on the right side of the trade until one day they're not. And maybe this is the one day one would expect silver to really start to move higher here right now. I don't like to make those kind of predictions, but I will tell you that this is very unusual to see how short the managed money is. At the same time, you have, right now that the LBMA is blowing up in terms of running out of stock, you have, for the 18th day in a row, backwardation between spot and futures. Right now, it's about $1.24. This tells you that the people are paying extra to get real silver now, not in the future. This is not bearish. This is a panic for the real metal. At the same time, short sellers are now paying a 19% annualized rate just to borrow SLV shares, where we see a lot of shorting, and a 39% lease rate on the LBMA. This is not indicative of a well-functioning market. Bank of America on Monday raised its forecast of silver to 65 per ounce by next year, with an average of 56.25. Until then, they also lifted their outlook to gold for 5,000. And the last thing that I will say is, and I may have repeated this last week, but for people who haven't heard this, you got 4 or 5 things that are incredibly bullish. You got, as we mentioned before, Morgan Stanley saying no more 60-40, 60-20-20. Get rid of half your bonds, buy gold with the other half. 60% stock, 20 bond, 20 gold. When have you ever heard a financial advisor say 20% in gold? This is from their chief investment officer, their CIO. This guy and the people that I'm about to mention speak to not the plebes, but to the institutional level traders, not to the rest of us. They're saying put 20% of your money in gold and pare down your bond holdings by 20%. Michael Hartnett for Bank of America, this is the one that just said, $65 on silver. Michael Hartnett's newsletter, I don't know how much it is, but I bet it's 10 grand a year. He just came out and said, no, it's 25, 25, 25, 25. 25% stock, 25% bond, 25% short-term treasury, and 25% gold. Whoa. Then you get Jefferies. Now, as you mentioned at the onset of this meeting, we were blessed by Prudential Beige about 20 years ago, and they nominated us. The authorized resellers, the 6 or 7 of them, can nominate one primary reseller, or the primary distributors can authorize one authorized reseller. And they did. Prudential Beige authorized us or nominated us to be an authorized reseller, one of 27, about 2 decades ago. God bless them for that. Walter Pahowicz, if he's still out there, Walter, you know I love you. He used to run their desk. They got bought by Jefferies. And Jefferies Beige was the name. Jefferies Beige was a primary distributor for all the major mints. They understand gold. They subsequently got out of the market, sold off the Beige name, and it's just Jefferies. Their head trader is saying $6,600 gold is their next stop. They understand gold. But maybe the biggest of them all is Jeffrey Gundlach, the bond king, the man who's made his mark, his fortune, and his moniker of being the bond king by selling bonds, who just came out and said a 25% portfolio allocation to gold is not overweight. Really? So when you see these people at these levels, and then put into it all the stuff coming into COMEX and the draining on the LBMA and the high lease rates and all of this stuff, the Judy Sheltons of the world, and the Trump saying he who has the gold makes the rules, and Bessent saying, I want to remonetize, be part of a new monetary. I mean, keep going. I'll keep going. And I'm telling you, and I hate to say it, I cringe saying it, but this time it's different. And look at gold. Got the snot kicked out of it by over $100 last week on Friday. And what are we at today? We're up $108 right now as we speak. The physical demand is different than I have ever seen, as are all of these things. People at that level, speaking to institutional traders at that level, saying 25% allocation is good. Never seen that before, man. Not even close. That's all I got. That's a mic drop moment.
In today's news recap, gold turns lower despite U.S. inflation data, set to end 9-week win streak. Gold prices paired losses on Friday after slightly softer than expected U.S. inflation data reinforced expectations that the Federal Reserve will cut interest rates next week, but the metal was still set for its first weekly loss in 10 weeks. Spot gold was last down 0.57% at $4,101.61 per ounce after falling nearly 2% earlier in the session. The price is down more than 3% for the week. Gold and silver jump as September core CPI comes in lower than expectations, but it's likely insufficient to entirely blunt this week's sell-off. Price action suggests that gold and especially silver need another leg lower before consolidation, said Tai Wong, an independent metals trader. Spot gold notched a record high of $4,381.21 on Monday, but has fallen over 6% since, as investors booked profits and signs of easing U.S.-China trade tensions dented safe haven demand. Labor Department data showed that U.S. consumer prices rose 3.0% in the 12 months through September, slightly below economists' expectations of a 3.1% increase. Traders are almost fully pricing in a rate cut at the U.S. Central Bank's meeting next week, with another expected in December. Lower interest rates reduce the opportunity cost of holding non-yielding assets like gold. Meanwhile, the White House confirmed on Thursday that U.S. President Donald Trump will meet Chinese President Xi Jinping next week ahead of the November 1st deadline for additional U.S. tariffs on Chinese imports. If gold prices fall below $4,000, we're going to continue to see more of a dramatic washout in the market, perhaps down to $3,850, the next major support level, said Philip Streibel, chief market strategist at Blue Line Futures. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com stackinggold.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
Physical metal tomorrow, and if he hasn't got it, he's got to go and lease it from somewhere. The lease rates have shot up. I mean, typically they were sort of up to 30-40%. And there's some reports of them going up to 100% and more, basically saying, there's no more left to lease. The other thing, of course, is that we see a backwardation, which by definition is when the spot price is above the futures price. And people got very excited with that being over $3 at one stage, which, of course, would prompt arbitrage. I mean, people with silver sitting in COMEX warehouses would think, okay, we'll ship some of that over and make on the arbitrage. So there've been lots of stories about that. Now, how true they are or whatever, I honestly don't know. I'm sure there's a bit of it, but it's probably exaggerated. What I would say is that the backwardation of spot